With interest rates hitting a 23-year high in this country, we need to have a conversation surrounding buydowns of interest rates. We all know the scenario where a buyer pays discount points to obtain a below market rate for their mortgage. It's a great option for a lot of buyers that entices them to buy when interest rates are higher. But there's another option I want to talk about today called a temporary buydown. I'm going to break this down for you. We're going to walk through the differences behind it. So follow along as we break this down for you. First and foremost, I want to talk about the difference between a temporary and a permanent buydown. A permanent buydown, when someone pays discount points, that money, the day of closing, is spent. The money is gone. As soon as closing happens, the money has been spent. If rates would drop 3 months later and the buyer wants to refinance, the money used to buy down the interest rate at closing 3 months earlier is gone. It's spent. When you're talking about a temporary buydown, the money is held. It is not spent, and that is the big difference between the two. So let's break down what this scenario looks like. I'm going to start this off by saying this is a hypothetical scenario, not an offer to lend. This scenario does not exist. This is simply a hypothetical situation to tell you the difference between a temporary and a permanent buydown. So the scenario we're working with today is a $650,000 purchase price at 10% down with a 760 FICO at a 7.5 hypothetical rate. In this scenario, the buyer is getting $15,000 of seller credit. This is something we are seeing all the time in the market right now as sellers try to entice buyers to buy in spite of high interest rates. Again, not an offer to lend. So let's take this scenario, 650 down or 650 purchase price, 10% down, 760 FICO, 7.5 rate with $15,000 of seller credits. And let's look what that looks like as a permanent buydown. A permanent buydown at a 7.5 rate, buydown is going to cost you somewhere right around $13,700 to buy that down just about 1%, around 6.625 would be the end payment or end interest rate for the buyer. That's going to save the buyer about $344 a month in payments. And we're seeing people do this all the time. It makes that monthly payment much more attractive. Now, the downside to this is, as we said, this $13,700 is spent the day you close. At $344 a month in payment savings, to earn back that $13,707, it's going to take about 40 months of monthly payments to earn back that $13,707. So if interest rates would drop in 6 months and the buyer wants to refinance, let's say rates drop to 5%. I'm not saying that's going to happen. I sure wish it would. But if it happened and the buyer wanted to refinance, the majority of that $13,707 is wasted money. This is where we look at a temporary buydown. Temporary buydown, we're going to talk about a 2-1 buydown in this scenario. There's also a 3-2-1 buydown and a 1-0 buydown as options. 2-1 buydown means you're buying down the interest rate 2% for the first year and 1% for the second year. A 3-2-1 would mean 3% the first year, 2% the second year, and 1% the third year. 1%, a 1-0 buydown is buying the interest rate down 1% for 1 year, and that's it. So in this particular scenario, the buydown is going to cost just about $14,000, $13,950, call it. That's going to buy the buyer's interest rate down 5.5% for the first year. That's going to save them a whopping $769 per month on their monthly payment. At 6.5%, the second year on their mortgage, it's going to go up 1%. That's $393 a month in monthly savings. If we go back here, we look, $344 is the permanent buydown. On a temporary buydown, year 2, you're still higher monthly savings than a permanent buydown. After that, for year 3 and going forward, it's going to go to the 7.5% rate. Now, this is where it gets really beautiful. This $13,944 is not spent at the closing table. That money is put into a separate escrow account that is held by the lender. And every single monthly payment that's made at the 5.5% rate, $769 comes out of that escrow account, and that escrow account balance goes down by $769. So if the buyer's looking to refinance, rates drop, same scenario, to 5% at the end of the year, 6 months into this, the buyer's going to refi in 6 months. Well, we take $769 per month in savings times 6 months means they have spent $4,614 out of that separate escrow account, meaning there's still $9,330 left in there. And again, the money's not spent, the money's held. That money is the buyer's. So you can look at this two ways. The buyer just got a $9,330 discount on their home purchase price, because when you go to refinance, that money, that $9,330, is taken off the balance of your mortgage, meaning you're not refinancing a $640,000 mortgage anymore. Now you're going to refinance a $631,070 mortgage. I hope I did that math right on the fly. If it happens in 12 months, 769 times 12 means we've spent $9,228 out of that account. There's still $4,716 left. That is the buyer's money. That money is used to decrease the principal balance of their mortgage when they go to refinance. So again, the money is not spent until the last payment is paid, or the money is spent incrementally as the mortgage payments are made. And the last money that leaves that escrow account is on the 24th payment at the end of the second year. So this is a great way for buyers to not lose out on money should interest rates drop in the future. Now, let's break down what this means in our scenario. So again, this is all hypotheticals, but in a scenario where we're offering things like this today, this can mean the difference of attracting a buyer or not attracting a buyer. Over almost $800 a month in monthly savings on a $650,000 purchase price is a very, very attractive thing to an individual buyer. If you have questions on this, if you'd like us to run at the Epic Mortgage team, all of my loan officers are extremely proficient in this. If you'd like us to run a scenario on a particular property, we can do that for you. These monthly savings are going to vary a little bit based upon the interest rate the buyer qualifies for, the purchase price of the home, and the down payment that the buyer's making. So these aren't just set in stone scenarios, something that we can run for you. Let's say you have a listing that's not moving and it's kind of sitting on the sideline. It's been 20, 30, 40 days on market, and you want us to run a 2-1 buy down scenario of what that would cost the seller to offer to a buyer. We'd be happy to do that for you. If you got questions, reach out. We're here for you and would love to be partners with you, making this transaction and every transaction amazing.